right, so welcome back to accounting. We are going to be finishing up chapter 6, which is the lower cost or market. Okay, so this is the chapter to see what happens when you have inventory that's been left over and you haven't sold it. Okay, because we live in such a consumer society, right? The main goal is we're trying to sell our products to all of our consumers and we are trying to get rid of our inventory. But because of the, you know, looking at technology these days, right? Every year something new and greater and better is going to be coming out. So what that does is it causes a lot of products to become outdated, obsolete, and no longer in production. And that is the dangers of having inventory and stocking it up very high, because what happens when those inventory items over time do not get sold? Well, because of technology, and that, of course, if I were to buy a 2017 laptop now, of course it'd be dirt cheap, but it's not going to have all of the functions. If I broke a screen, if I broke something on the keyboard, I won't have that, piece to be able to fix it again, right? Because it's out of production. So at the end of the day, what happens to that 2017 laptop is that it becomes useless. Maybe the modem, the processor, it's using old materials, right? Because of course with the advancements of technology, that means there's improvements with materials and things right now, right? We don't use copper anymore, we use fiber optics now, right? So think about that. So in that case, it's definitely a lot more cheaper and it's a lot more better. And you can imagine, right, if you bought a laptop in 2017 and fast forward to 2020, 2022, right? Do you think that computer's still going to function the same way as if it were back in 2017? Probably not, right? Because you used it so much, the battery's worn out, and eventually it's going to cost you way more money to fix it rather than just invest into a new one, right? A new, better, improved, with better technology type of laptop, right? Because back then, if you ever owned a laptop way back when, maybe in 2010, 2000, earlier those days, the laptops were clunky and heavy. Nowadays, the laptops are thin and they're so portable, right? And we even have newer technology like the Surface Pro, where it can convert into a tablet and then you can snap the keyboard right on there and it's even more portable, right? Technology is advancing and it happens every single year, every day, every month. So in this case, right, if we do not sell our inventory by a specific certain time period, right, eventually those items will become old and they lose value over time. So in this case, right, we have to acknowledge that we will come to a point where we would have to adjust our cost prices because it's not going to be worth the same as it did back when you originally purchased it. Okay? So that's the idea of what lower cost or market does. Is it's your means to take your inventory, right? Do some research on it, check the market to see what the value of it is now, and compare from when you purchased it to the market and figure out which one's lower, the original cost or the market cost. And then from there, you're going to adjust if necessary, okay? So when we're looking at the lower cost or market, there are 4 things you need to know. You need to know what the ceiling price is, right? Your ceiling price right here will go through each and every single one, okay, of what it does and what you need to do to figure it out. You need to figure out your floor cost or floor price, okay? Then you're going to determine the market value, okay, or the market price, the market cost, whatever you want to call it. And then you're going to determine which one's lower, the original cost that you purchased it at, or the market cost that society is telling you it's worth that. Okay? So in this case, let's go ahead and dive into our first example here on solving for my ceiling price. Okay? Now these numbers will be given to you because again, it's not your actual real job to figure these numbers out. Your job is just to record the adjustments if there is one. But in this case, I want you to not just have to be like, well, what happened to it? How did we get this number? That's what I'm going to teach you here today, okay? So this position is going to be mainly for the person who's in charge of inventory or for purchases in general, okay? So in this case, right, my original cost, let's say, I don't know what item but I purchased, but this is what I originally purchased it at per item. It cost me $5.04 per item. And I went ahead and looked at the market, and the replacement for it would be $4.89. Now, in this case, right, you need to go through the calculations to determine what the market should be, not what it tells you it is, okay? So that's why there's the replacement cost, meaning when you did your research, other people are telling you that it is worth this much. But you will have to determine what that market is by doing your calculations. Okay? Excuse me 1 second. Okay? So once we these numbers should be given to you by your purchasing manager or your inventory manager, right? That your original cost is $5.04. Someone's telling you that now it's being marketed at $4.89, right? Your original selling price is in your store is $8.17, and the cost to get rid of it is going to cost you 87 cents. And then you want a 40% profit, which means you want to earn at the end of the day at least $3.28 profit after the sales, right? Because if you think about it, we talked about how you get the profit, right? It's where you take your cost of it, of your inventory assets minus the total selling price is going to give you your profit margin, okay? Or if you want to add in a profit margin, then that's where this number came from, okay? These 6 numbers are always going to be given, okay? You are not responsible to figure this out because this is the inventory manager's what they have to record and have to give you, okay? So once we have all of these numbers, right, now we can go ahead and proceed with our lower cost of market, right? So first we need to determine the ceiling price. The ceiling price is going to be your selling price minus the cost of disposal. So in this case, my selling price is $8.17. And how much is it going to cost me to dispose or to get rid of or sell? It's going to cost me 87 cents per item. So in this case, right, simple enough, right? I have my selling price, I have my cost of disposal, and I need to subtract the two. So $8.17 minus 87 cents is going to give me $7.30. This is my ceiling, the highest number, okay? Next is going to be your floor price, okay? How do I solve for my floor price? The formula here is going to be your net realized value minus the amount of profit. What is net realized value? That's the same thing as your ceiling price, okay? Your net realized value is going to be given that this is going to be your selling price minus your cost of disposal. That is your net realized value. Okay? But in this case, we're just that's just terminology. Your net realized value is going to be the same thing as your ceiling price. So you could just simply take your ceiling price and you're going to minus an additional amount of profit. Okay? So in this case, I got my ceiling price of $7.30, and I'm going to subtract $3.28, right? And that's going to give me $4.02. Okay? Now here's the next step. Next step is going to be determining the market value. Okay? Now the market value, right? In order to solve for the market value, what you're actually going to do is it's going to be a comparison between three numbers. Okay? And that's going to be your replacement cost, your floor cost, and your ceiling cost or ceiling price, okay, whatever you want to call it. So in this case, those are the three numbers that you're going to use to compare. Now, of course, if the replacement cost is less than ceiling, okay, that meets one condition, all right? And if the if the replacement is greater than your floor, then your replacement cost is going to be your market value, okay? But for any reason that you have this condition where your replacement cost is less than your floor, then your floor becomes your market. What does that all mean? I'll give you an easier way to understand this, right? Let's go ahead and take those three numbers and compare it on a number line. Put it highest to lowest, okay? So my highest value is $7.30, which is my ceiling price, right? My lowest value is $4.02, which is my floor price. And of course, the number that falls in between them or is, not greater than but less than is going to be my replacement cost at $4.89. What I want you to do here is once you put it in numerical value order, I want you to choose the number that's in the middle, okay? Because this number is going to become your market price, okay? Easy way to do this, okay, is to compare all three numbers, put it on a number line, and look which one is the highest, which one is the lowest, and therefore you got, boom, your market price, okay? All right? So you can also think of it this way too. Your ceiling, right? Your ceiling usually it's a ceiling, right? You can't go above the ceiling, right? And your floor, you typically can't go below the floor. But in this kind of circumstances, your replacement cost could fall below the floor price. And what we want is what's in the middle, what's in between the ceiling and the floor. Okay, but in this case, the replacement end up being the middle number. Okay, so then this becomes your market price. All right, and then of course, last but not least, right? Answer the question: which one's lower? Your original cost of $5.04, or your market cost, which we already solved for to be $4.89. And that's what you have to do. Step 4, answer the question, which one's lower? In this case, my market price is lower. So that means I have to adjust my inventory because I purchased it originally at $5.04, right? But now it's telling me it's not worth that anymore. I end up losing what is that? 14 cents, 15 cents. I end up losing 15 cents per item, okay? Because I lost it due to the market, right? Any questions here? Yes.
Didn't you say amount of profit is the difference between original cost and in the selling price?
It's supposed to be, but because that's how much money you want to earn out of it.
Okay.
Okay.
So it's not necessary. It's a difference between the two numbers.
No. But in this case, it's a guesstimation, right? Because this is what I
Okay.
want. If I'm selling my product at $8.17, I
Mm-hmm.
hope to try to gain the maximum percentage of at least 40%,
Okay.
which is at $3.28. Now, of course, if you do subtract them, they might not add up. But that's your goal is you're going to set a selling price that it is going to at least give you a 40% profit. But in this case,
Okay.
if I end up having to reduce my cost, then
Mm-hmm.
obviously I won't be able to sell that price at $8 anymore because it's also telling you, hey, this item is not popular anymore. It's outdated. No one's going to buy it for the price that you're selling it for.
Okay.
Mm-hmm.
Because the difference between selling price and original cost is $3.13, but it says 3.28. That's where I was a little confused. So you were
Yeah.
saying,
It's a guesstimation. Your hopes is to get at least 40% profit.
okay,
Mm-hmm.
all right, thank you.
Mm-hmm. Okay. Any other questions? Hey. So let's again, so when you are on step 4, your job is to choose which one's lower, right? Is it going to be the original cost of $5.02, or is it going to be the $4.89? In this case, $4.89 is lower, so your market is lower. So let's go ahead and do an example here, and let's practice what we can here. So for instance, let's do another example where um, so we just did the first one, okay? So the second one says that, well, our original cost per item was $4.01, but the replacement cost is going to be $3.92. You sell this product for $8 even. To dispose this item, it's going to cost you 40 cents per item, and you want 45% profit at least, so you want at least $3.62. Okay? So I need to go through all of my calculations again. So the first two are the calculations, okay? So I need to solve for my ceiling. What is my ceiling price for example 2 here?
$7.60.
Okay, right? It's $8 minus 40 cents gives you $7.60. Okay, how do you solve for your floor?
760 minus $3.62.
Mm-hmm.
398.
398. Good. And then now we need to determine what the market value is. So this is where we're going to compare three numbers, right? We're going to compare my ceiling at $7.60, my floor at $3.98, and my replacement at $3.92. So in this case, which number is going to be in the middle?
The floor.
The floor, right? So it's going to be $3.98. So this is where some people get this confused. They always think that the replacement is always going to be the market. If that was the case, then why would we need to go through all those calculations, right? You wouldn't need to if you already knew that your replacement is going to always be the market. No, in this case, in this particular scenario, no. The floor ended up being the market because it was more than 92 cents, right? It's 6 cents higher. So in this case, right, my market is $3.98. So now we need to compare and answer the question. Which one's lower? My original cost or my market?
The market.
The market is lower, yes, at $3.98. Okay. Last example here is going to be that we originally purchased per item $3.49. Right now it is $3.05. And we sell this for $8.25. To dispose it's going to cost me 95 cents. And the amount of profit is $3.50. So, what is my ceiling?
$7.30.
$7.30. Good. What's my floor?
$3.80.
$3.80. Okay. And then which one is going to be my market if I have to compare three numbers? $7.30, $3.80, and $3.05.
Floor.
The floor,
Floor price.
correct, right? $3.80 would be the one that's in the middle when you compare all three numbers, right? So then, let's answer the question. Which one's lower? My original cost or the market?
The original cost.
The original cost of $3.49. Good. All right. Okay.
So you would do your inventory then with your adjustment at the original cost, not at what the market is.
That's what I'm going to talk about right now. How do I record this, right? Because in this case, right, I originally already bought all of these items at my cost price, right? But what happens when it's the end of the year and I'm making my adjustments to inventory, right? And I know that the product that I sell is going to be sooner or later outdated, right? Let's say I am an electronics store place, right? I know for a fact that no one's going to be wanting to buy my Dell 2022 laptops nowadays, right? Because everyone's going to go for the 2023 laptops, right? So in this case, if I were to go ahead and adjust it by the end of the year, then you have to make an inventory adjustment entry, okay? Because you already purchased it at the original selling price. Now you need to adjust it, okay? So that's exactly what I'm going to do because that is what you guys are responsible for is what are these calculations for? It's to determine so you know where these numbers are coming from. Instead of, receiving these numbers and expecting to just journalize them, you kind of want to figure out why. Where do these numbers come from? And that's exactly what I just showed you. Now, your main job is to journalize it. Well, in order to journalize it, you have two methods. You have the direct method and the indirect method, okay? Both of these are valid ways to properly journalize our adjustments to inventory, okay? Now, again, this is going to be an adjustment entry that you also include with your conversion entry. So when you're completing your conversion entry, the next line after that's going to be adjusting that inventory, okay? So that's very, very important that you do complete this. Now, when do you complete it? It really depends, especially on the items that you are looking at. You wouldn't necessarily need to run a lower cost of market on an item on a monthly basis, right? This is typically something that is usually done at the end of a year because a year gives the asset, some time to age, right? And it really depends on the items that you sell. So if you're selling coffee, then of course no, that's the lower cost of market's not going to affect it by very much. But if you sell electronics, for sure 100% because again, technology these days, it's one of those things that what you originally purchased an item for is not going to hold its value over time. Okay, so it really depends on what kind of item you sell in particular, And then of course once you have that and it's periodic inventory, you're going to have to adjust it probably most likely towards the end of the year, just to give it some time to age and to actually lose value over time. Okay, now again, we have the direct method and the indirect method. The direct method allows you to adjust the inventory and not recognizing a loss. Okay, so what happens here is, this is perfectly legal, is that instead of recognizing it as a loss, what you're going to actually do is you're going to actually shove it into cost of goods sold. Okay, so that means whatever amount that you paid for to purchase these items, you're going to take the loss and pretend as if you sold those items. So therefore, it's going to be placed into the cost of goods sold. Okay? Where the indirect method allows you to adjust your inventory, right, by creating an expense account that is going to recognize the loss on the cost of the inventory. Okay, so let's take a look at the first one. Since we are using periodic inventory, right, let's just take a look at what we purchase and how we can adjust it then. Okay, so again, starting here where we purchased 1,000 units at $1.25 each on January 1st of 2020, and then at the end of the year you need to adjust your inventory due to the market. Okay, and the market cost now is $1.15 per item. So in this case, right, here's a nice chart that tells you here that maybe you bought some coffee mugs. It was nice. The material that you bought the coffee mugs was, I don't know. It dropped value a year later. Okay, or by the end of the year. So in this case, you purchase 1,000 items and it cost you $1.25, and then when you look at it now at the end of the year, it is now actually $1.15. So in this case, right, let's look at the total cost. So that means my original total cost was $1,250, while now it's worth $1,150. Okay, so how do I actually recognize that there is a difference between the two? So once again, you already completed your conversion entry, so this is what you have to tack on now. You need to put in that your inventory, right, so as of December, right, is now going to be at $1,150. And what happens is you're just going to shove that amount in the cost of goods sold. Okay? So you don't even recognize that you took a loss. You decided to just put it into a expense account and you dumped it into the cost of goods sold. So in this case, right, you're recognizing what it cost you now and it put it in here into the cost of goods sold. Now in this case, this is completely correct, but it is probably going to be the most confusing as it can be, right? Because in this case, this is just you shoving your difference, in this case not your difference, but the when you did your conversion entry, right, you recognize that you had 1,250 items. Now you need to recognize that you only have 1,150 total in items. Okay, and you have to shove the rest into the cost of goods sold. So in this case, it really depends on whether you like this method or not. Like I said, it is very confusing because it's kind of like, where did that $100 go? I don't see it. So that's why the indirect method would be probably the most preferable, because in this case, right, you actually recognize the difference and you actually take it as a loss. So what you're going to do is you're going to do the same thing, right? You got the inventory and the cost of goods sold for the regular amount, right? That's correct. And then you're going to recognize your adjustment by saying you have an expense account, and you're going to name it loss on the market decline of inventory, right? And you're going to create a account for that to reduce the inventory. So in this case, you're going to do it for the difference amount of $100. So in this case, this one's more, I would prefer this method a lot better just because you could see that, hey, when you journalized it and you did your conversion entry, you're entering it for the correct amount. But then you're gonna also recognize that you have a market loss difference right here of $100. Okay, and that is the periodic for a periodic inventory. Okay, now for the sake of this class, I'm not gonna test you on journalizing this because I really just want you to be able to just get the number, just the calculation portion. So the journaling is not necessary just because, you know, this happens when you do your conversion entry, and we're learning the very basics. So this is actually a little slightly advanced accounting, but it's definitely something that you should know, that the inventory that you purchase doesn't hold its value, especially when you purchase it at a high cost. Again, especially with technology, right? You can't expect a year from now that someone's going to purchase that same exact item from you for the same price, right? Especially because it's been aged, right? Right? I also included the perpetual inventory direct and indirect methods as well, but you don't need to know that yet. So other than that, for the chapter review, all I really need you to know is how to solve for the lower cost of market, right? You need to figure out what you're selling, your ceiling price is. You need to know what your floor price is. How are you going to compare that to solve for your market? And last but not least, you need to figure out, is your original cost lower than your market cost? Okay? All right? So any questions so far? Right? Because we have, let's see, I think we have 10 more examples to go through. Yes.
We don't call the price lower cost of market if the item is seeked more, meaning it got popular. Like some toys, it's really popular in the market value.
Okay.
So in that case, we don't call it lower cost of market.
Well, okay, so in this case, if you have a potential, why I am doing this is because this has to do with your historical cost. Okay? Because
Okay.
what you're trying to, if an item is popular, of course, you can increase the selling price, right, to
Okay.
earn a
Yeah.
higher profit. That has
Yeah.
nothing to do with the lower cost of market.
Oh, okay.
Because we're looking at how much it cost me. Okay? Now let's say that toy, right, came out 10 years ago. Do
Yeah.
you expect that toy to hold its value over time?
Generally, no.
No, because let's say you bought $100 per item, right? And
Yeah.
fast forward 10 years later, do you think it's still worth $100 or cost
Probably
wise?
no.
Probably not, because it's scrap at that point, right?
Yeah.
The plastic's old. There's probably better toys out there. So in that
Yeah.
case, then that value that you originally purchased at is not going to hold its value in your inventory. So that's why you
Yeah.
have to adjust it. That's what we are doing, is that, oh, because this item is so outdated, even if I did sell it, right? If someone
Mm-hmm.
comes into problems with it, they're not going to pay money to fix it because it costs more to fix it than it is to just buy a brand new toy.
Yeah.
Do you understand?
Okay.
Okay. So that is why we are doing the lower cost of market, because
Okay.
on our books, when we record at historical cost value, it doesn't stay that value in our books because of us living in a consumer society. Advancements of technology is what pushes and drives our inventory to fall below what we originally costed at.
Okay. Thank you.
Yes. Okay, so yes.
So then the reason we use lower cost of market is mainly for tax purposes, to make sure that we're valuing our inventory at the proper amount for taxes.
Absolutely correct.
Okay, thank you.
Because again, right, depending on what kind of business you are, some of these expenses can be written off. If you're a small business, you can write off a few losses. But again, I'm not a tax accountant. I cannot tell you the exact tax code or the exact items that you can, because it really depends, right? Whether that item is on that list for the IRS that can be you can deduct it off your taxes. Okay, but for small businesses, again, you and the business are one. So if you get to take that business tax off, most likely because you're a sole proprietor, you guys get a lot more advantages for a lot of reasons or you get a lot of special advantages for taxes if you're a small business sole proprietor or one only owner only. Okay, whereas a corporation, they're going to get taxed no matter what at the highest bracket, and finding so many other taxes that they can be taxed at, because they're making billions of dollars, where your small business might not be making that much money. So again, there are those kind of rules and regulations, right? The more money you make, the more taxes you will be incurring. So same concept here. So for instance,
So
yes.
our job then is to make sure we take all the numbers and put together something accurate that the tax accountant can use to do it properly.
Correct. 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 Okay. So any other questions?
Nope.
All right, let's go ahead and dive right into the exercise right here. So we got 8 items here that just given some examples here. Like I mentioned before, you're going to be given the original cost, the replacement cost, the selling price, the cost of disposal, and the amount of profit. Okay? So in this case, profit percentage is pretty straightforward, right? You'd be able to figure that out if you're, the profits manager. But in this case, you are just the accountant. Okay, so in this case, I only need you to know just actually these 6 numbers here, or these 5 numbers. So again, these numbers will be given, and I will provide you those numbers on the exam. Okay. So let's go ahead and dive into the first one. You bought some chips. They were special edition chips, so special flavored chips. They cost you 89 cents per bag. And then, of course, it's worth 49 cents a bag. You sell them at $3.99 each. To dispose them, it's going to cost you 15 cents per bag. And, of course, the amount of profit you want to get out of it is $3.05. So, what is my ceiling price?
$3.75.
$3.75. So we took our $3.99 minus 15. Oh wait, you got $3.75? What did you do?
Oh, isn't it the selling price minus the disposal?
Minus cost of disposal, which is 15 cents.
Which is $3.99. Oh, yeah, that does come up different. I must have put something wrong in my calculator. Sorry.
No worries. Okay, so it's $3.84. Okay. What is my floor price?
$0.79.
79 cents. So we took our ceiling price of $3.84 minus my amount of profit for $3.05, and we get 79 cents. So in this case, what should be my market value if I'm comparing my ceiling, floor, and my replacement?
The 89 cents original cost.
Okay, so we're not looking at original cost yet. We're looking at replacement cost.
Well, then the floor price.
The floor price of 79 cents. Good. Okay? Now we can compare my original cost to the market. Which one's lower?
The 79 cents.
79 cents. Good. So that means we have to adjust our inventory to reflect that we lost some values on the chips. Okay? All right. I bought some cups for $2.59 each. Okay, right now it's the replacement cost is going to be $2.49. We sell them at $8.99. To dispose them is going to cost me 75 cents. And then the amount of profit I want to get out of it is $5.84. So what is my ceiling price?
$8.24.
$8.24, right? We take our $8.99 minus 75 gives you $8.24. What about my floor price?
$2.40.
$2.40. So again, $8.24 minus $5.84 gives you $2.40. Okay. So now I need to determine what is my market price. If I have to compare my ceiling, my floor, and my replacement of $2.49. So what is going to be my market?
$2.49.
$2.49, right? It's definitely higher than the floor price of $2.40. So in this case, yes, my replacement is my market. So then, last but not least, which one's lower? My original cost of $2.59 or my market at $2.49?
$2.49.
$2.49 is definitely lower. Okay. Then I bought some limited edition t-shirts for $1.98 each. It is now worth $1.66. I sell these shirts at $4.99. And to dispose them is going to cost me 22 cents. So the amount of profit I want to get out of it is $2.99. So what is my ceiling?
$4.77.
$4.77. Good. Okay. What about my floor?
$1.78.
$1.78, right? You take your ceiling of $4.77 minus that amount of profit for $2.99, you're going to get $1.78. So now, once again, let's compare these three numbers. You got the ceiling, the floor, and the replacement cost of $1.66. Which one is in the middle?
The floor.
The floor of 178 is definitely higher than the replacement of 166. So that means the market price is going to be $1.78. So let's solve the answer. Which one's lower? Original cost of 198 or my market at 178?
Market.
Market of 178. Okay. All right. Next one here, we have some limited edition pants that we originally bought for $5.25 each. It's now worth, and it's now cost me $4.98, excuse me. I sell them for $14.99. To dispose them, it cost me $1.85. And of course, the amount of profit is $8.15. So, what is going to be my ceiling?
$13.14.
Right? We take my selling price minus amount of disposal for $13.14. Okay. What's my floor?
$4.99.
$4.99. So then, what is going to be my market if I have to compare my ceiling, my floor, and my replacement at $4.98?
The floor by 1 penny.
The floor by 1 penny. Yes. Okay. So that's why it's very tricky. You have to make sure that you look at this very carefully, because sometimes people will be like, oh, it's going to be the replacement at 98 cents. No. If you look at it really carefully, it's actually the floor at $4.99. Okay, because it is higher than the replacement. So once again, what is lower, the original cost of $5.25 or the market price at $4.99?
Market.
Market. Okay. All right. But the next one here is we bought some nice hats for $2.58. It now costs $2.05. I sell these hats for $9.99 to dispose them. It's going to cost me 59 cents per hat, and then the amount of profit is $7.49. Okay. So, ceiling
$9.40.
$9.40. Floor
$191.
$191. So let's figure out what the market is. If my my replacement cost is $2.05.
Placement cost.
Replacement cost of $2.05. So which one's lower? Original cost at $2.58 or my market price at $2.05?
Market.
Market. Okay. Okay. Then we bought some toys for $1.05. It's now telling me it's worth 98 cents. Okay, I sell these toys for $6.99. To dispose them is going to cost me 11 cents, and the amount of profit is going to be $5.81. So what is going to be my ceiling?
$6.88.
$6.88. Okay. What is my floor?
$107.
107. So, comparing the ceiling, floor, and replacement cost of 98 cents, which one is going to be my market cost?
Floor.
The floor of 107. So, last but not least, which one's lower? My original cost of 105 or my market price at 107?
Original cost.
Original cost. Okay. All right, last two examples here. So I bought some pens that are worth 78 cents for a pen. It's telling me now it's worth 33 cents. I sell my pens for $2.99 each. It's going to cost me 7 cents to dispose, and the amount of profit is $2.24. So what is my ceiling?
$2.92.
$2.92. What is my floor?
$0.68.
68 cents. Now comparing my ceiling, my floor, and my replacement cost of 33 cents, which one is going to be my market value?
The floor.
The floor of 68 cents. Good. Last but not least, which one's lower? Original cost at 78 cents or my market price at 68 cents?
Market.
Market. Okay. Last example here. Again, we bought a laptop for $584.60. It is now worth $562.17. You sell it at $849.99. To dispose, it's going to cost you $129, and the amount of profit you want to get at it is $127.50. So what is my ceiling?
$720.99.
Okay, so when you take my ceiling, my selling price at $8.49.99, cents minus 129. You're going to get 720.99. Okay. What is my floor?
$593.40.
Oh, nope, I got to keep going. There you go. 593.49. Good. What is going to be my market if I have to compare my ceiling, my floor, and my replacement at 562.17?
The floor.
The floor of 593.49. Okay. And last but not least, which one is lower, my original cost or my market price?
Original cost.
Original cost of 584. So that tells me if for any reason that your market, right? Or I'm sorry, once you solve for this, right? If your original cost is lower, that means you do not need to make an adjustment entry. You only need to make adjustment entry if you actually took a loss. Now, oftentimes, it is very rare that you'll come across an inventory item that will increase in value, okay? Usually that is due to less materials that are being supplied, so that will be the only case. But most cases, especially again, given on the items that you are selling, most likely you're going to have a loss to more likely occur than a gain. Okay, so all right. All right, good job, everybody. That is it for today. Like I said, this is a simple chapter of part of chapter 6 here.